In the United States, a single three-digit number can decide a lot. Whether you get approved for a car loan, whether you qualify for a credit card, even whether you get an apartment. That number is your credit score. But how does one number carry that much power? And what is it actually measuring? A credit score is not random. It is a prediction. It tries to answer one question: how likely are you to pay back borrowed money on time? Lenders use this number to judge risk. Higher score. Lower risk. Lower risk usually means lower interest rates, lower monthly payments, more options. Lower score means the opposite. So let's break down how this system really works. We will look at three things: where the data comes from, how the score is calculated, and what habits move the number up or down. Before you have a score, you have a credit report. A credit report is a record of your borrowing history. In the United States, three main companies collect this data: Equifax, Experian, TransUnion. These are private companies, not government agencies. Banks and credit card companies send them updates, usually once every month. They report how much you owe, whether you paid on time, when accounts were opened, when they were closed. The bureaus store the facts. They do not decide if you are good or bad. They simply hold the data. The score comes from a formula. Companies take the information in your credit report and run it through a mathematical model. The two main scoring brands are FICO and VantageScore. Most large lenders use FICO, but both models are common. They usually use a scale from 300 to 850. Higher number means lower predicted risk. The formula is designed to predict something very specific: the chance that you will fall seriously behind on a bill within the next 2 years. It is not judging your personality. It is estimating probability. This is the most important part. In many FICO models, payment history makes up about 35% of your score. This category answers one simple question: do you pay your bills on time? If you consistently pay on time, the system sees reliability. If you miss a payment by 30 days or more, the score can drop quickly. Because past behavior is the strongest signal of future behavior. One late payment can hurt. Several late payments can hurt more. Consistency matters here more than anything else. The second largest factor is how much of your credit you are using. This is often called credit utilization. It is not just total debt. It is the percentage of your available credit that you are currently using. For example, if your credit card limit is $1,000 and your balance is $300, you are using 30%. Lower percentages are generally better. Many experts suggest staying below 30%. People with very high scores often stay below 10%. This factor makes up about 30% of many FICO scores. High balances signal higher risk. Low balances signal control. The system also looks at time. How long have you been using credit? Older accounts help. They show a longer track record. Closing very old accounts can sometimes shorten your average history. The system also looks at credit mix. Do you only have credit cards? Or do you also have installment loans, like a car loan or mortgage? A mix of account types can help slightly, but this category is smaller. It matters less than payment history or balances. When you apply for new credit, the system notices. This creates a hard inquiry. A hard inquiry can lower your score slightly for a short time, because applying for several new accounts quickly can signal financial stress. There are also soft inquiries. These happen when you check your own score or receive pre-approved offers. Soft inquiries do not affect your score. Over time, hard inquiries fade, and as new accounts age and show on-time payments, they can begin to help instead of hurt. Credit data does not stay forever. Most negative marks, like late payments, stay on your report for about 7 years. Positive accounts can stay longer, often up to 10 years after closing. This means mistakes fade with time. The system has memory, but it is not permanent. When you zoom out, the system is simple. The bureaus collect data. The scoring models apply math. Lenders read the result. Your daily habits feed the system. Pay on time. Keep balances low. Avoid unnecessary applications. Over time, the system updates your score based on consistent behavior. Your credit score is not a label. It is a moving snapshot of how you manage borrowed money. And the reason it feels powerful is because many financial decisions are built on that single prediction. When you show stability over time, the system reflects that stability back to you. This is Simplexplain, complex ideas simply explained.